Welcome guys again to our YouTube channel, So guys, today we have another bang in this video guys, whereby we will be speaking about depreciation on tangible assets. Whenever they say tangible assets, meaning they are talking about what? Fixed assets. Something that you can touch, something that you can what? You can see. So we have what? Fixed asset. So guys, let's take a look at the definition of depreciation. What is meant by the word depreciation? It is a reduction in a value of an asset over time due to what? To particular wear and tear. Meaning whenever we use our asset, then our asset will do what? Will depreciate because of what? We are using our asset. And then depreciation is an imputed expense, does not affect cash position of the business. The cost price of the business will affect the cash position, but it's allocated at a specific accounting period. So guys, what are those assets or tangible assets we are speaking about? We are speaking about what? We are talking about the land and building, but land and building does not depreciate, but it does what? It accumulates. It accumulates. So meaning our land and building does not what? Depreciate. It only what? Accumulate. But the things that fixed assets in which they depreciate will be what? Will be a vehicle, because of we are using vehicle in our daily lives as well as our what? Our equipment. So guys, let's take a look at the different types of method in which we are going to use whenever we calculate what? Depreciation. We have a fixed method. What is a fixed method? Fixed method is something that is fixed, something that is specific, and then it says takes place over a what? A useful time of the asset at a rate, e.g. over 5 years. Meaning in under what? A fixed method, we are talking about cost. On cost, we are also talking about a what? A straight line. Meaning a fixed method, it's a what? It's a cost method, or a what? A straight line. And then we have another method of depreciation, which is what? A diminishing balance method. Let's find out what is happening. Writing off depreciation on the what? On the carrying value, meaning we are writing off depreciation or calculating depreciation based on what? On our book value. Then it's what? If ever you don't want to say book value, you can also say what? Carrying value at a fixed percentage. And then writing off takes place over a what? A longer period. And then guys, now let's take this method of us and take a look at a what? A given transaction and try to calculate depreciation. So guys, what I will always advise my learners is that always have your timeline. As a accounting learner or accounting student, always have your what? Your timeline. And then guys, it says the information, it's activity 1, the financial year ended on the what? 31 December 2020, meaning the 31 December 2020 is the what? Is the end of our financial year, meaning we are going to have December 2020, meaning it started when guys? In our financial year, it started when? Started January. Then we are going to have January 2020, and then February, March, April, May, June, July, August, September, October, November, as well as our last month of our financial year, which is what? December. And then guys, right now we can be able to read our information. It says balance of equipment account in the general ledger on the 1st of January it's how much? 90,000. But when the first of January, then we have what you call an old equipment with a cost price of how much? 90,000. And then we are going to say we have an old equipment with a cost price of how much? 90,000 at the beginning of our financial year. And then guys, we continue now. Bought a new cash register, meaning now we bought a new cash register, our equipment, for how much? 5,000. When? The 1st of July. The 1st of July, guys. And when it comes to accounting, dates are very important. At the beginning of July, then it's January, February, March, April, May, June, July. The 1st of the 1st of July. First of July, we had a new cash register, we had a new equipment with a cost price of how much? Of 5,000 rand. And then guys, we are going to write our new equipment. It's how much? 5,000. So now let's calculate depreciation. Let's follow. And then it says required. Calculate depreciation on the 31 December 2020 at the what? At 10% per annum on cost. Meaning, guys, and I told you, if ever you don't want to say on cost, they will say sometimes on what? Using a straight line method, meaning it's a straight line method. So now, guys, we are given a rate of how much? Of 10%. So now let's calculate depreciation, meaning we have two items. We had an equipment at the beginning of our year. We also had equipment at the in the middle of our financial year. So guys, let's calculate depreciation. Then you are going, since we are using a cost price or a straight line method, meaning it's straight, it's a fixed, as we were able to identify our method, then this one it's it's a fixed method of depreciation. Then we are going to say 90,000. We are going to say 90,000 multiplied by our rate, which is 10%. 10 over what? Over 100. And then this equipment will be used in the business for how many months in our financial year? Since we know our financial year starts January, then because of it's old and we are not selling it, then we are going to start counting. It's the first month, second month, third month, fourth month, fifth, sixth, seventh, 8, 9, 10, 11, 12. Meaning this old equipment will be in the business, will be available in the business for how many months? For 12 months, over 12. And then how much is our depreciation? Then guys, we are going to say 90,000 multiplied by 10 over 100, since this is the our given percentage, multiplied by how many months will the equipment be available in our business during that financial year. Then it's 12 months. And then we are going to say 90,000 multiplied by 10 divided by 100 multiplied by 12 divided by 12. Then this old equipment will depreciate with how much? With 9,000 rand. It's for old. So now guys, let's continue calculating depreciation for a new equipment in the business. And then guys, we are also going to apply the percentage. And then since it's on cost, it's multiplied by 10 divided by 100 multiplied by the month in which this new equipment will be available in the business. So guys, I was telling you that it is very important that you know your dates. Then guys, if ever we bought the equipment the 1st of July, meaning the equipment will be available from the 1st of July. But if ever we bought this equipment at when? The 31st of July, meaning this equipment will be available when? The following month, which is what? Which is August. So now, since they told us that we bought our equipment 1st of January, then it's available this month. It's what? It's available this month. And then guys, we are going to what? To start counting, and then it's going to start counting the July, because of it was bought the 1st of July. It's 1, 2, 3, 4, 5, 6, meaning the new equipment will be available in the business for a period of how much? Of 6 months. And then it's 6 divided by 12. And then guys, we're going to say 5,000 multiplied by 10 divided by 100 multiplied by 6 divided by 12, and then it's going to depreciate with how much? With 250,000. And then guys, depreciation for the entire year is going to be how much? The depreciation for entire year is going to be how much? It's going to be our 9,000, which is the old, and then plus, and then it's going to be what? Plus our new equipment, which is 250, which is a what? A new. And then our final answer is how much? It's going to be 9,000 plus 250. Then we have 9,250 as our depreciation for the year. And then guys, in this one, as we spoke, it's what? It's a cost price method. So guys, let's take a look at the what we call the diminishing balance method. So guys, in its activity 2, let's continue. So it says information balances appear in the books of March 2020 as follows. So right now guys, we are not sure which one is our what? What is the end of our financial year. And then we have equipment for how much? For 40,000. We have equipment for 40,000, and also we have accumulative depreciation for how much? For 7,600. And then it says bought new equipment for 96,000 on the 1st of November 2020. And then guys, required calculate depreciation on the 28th February. So now guys, we know that 28th February is the end of our financial year. At what rate? At 10% per annum on diminishing balance method. Always guys, do not forget to show your timeline. And then guys, we have our timeline. And then the end of our financial year, it's when? February 2021, meaning the beginning of our financial year would be what? March 2020. It's March, April, May, June, July, August, September, October, November, December, as well as January. And our financial year, it's 12 months period. And then guys, now we can do what? We can fill up our financial year. Always fill up your what? Your financial year. And then we go back to our information. Balances appear in the books of 1st March. Then we know we have what? 1st March. 1st March, it's our what? Our old. And then we are going to write our old. How much is our equipment? How much was our equipment at the beginning of our financial year? It was 40,000. And then we are going to write what? 40,000. And then we also have accumulative what? Depreciation. And then we'll bear it in what? In mind. 7,600 is our accumulative depreciation. And then the following point says bought new equipment for 96,000 when 1st of November. And then we are going to do what? We are going to go for 1st of November. This is our November. And then we have what? We have new. And then for how much? It's for how much? It was bought for 96,000. It was bought for 96,000 during November. And then guys, we can put everything in our answer sheet, and then we'll say we have old equipment for how much? That is worth 40,000. And then we have new equipment that is worth how much? 69,000. And then guys, can I just change my pen so that everyone can be in the same motion as I am. And then guys, we have what? The new equipment for how much? For 96,000. So now everything guys has been what? Has been understood, and then our timeline has been what? Has been completed. And then guys, what we can do now, it says required calculate depreciation on the 28th February at 10%. So now we know we are going to use what rate? 10% per annum on what? On the diminishing balance method. So guys, as they told us about the diminishing balance method, that we are going to use what? The carrying value. We are not going to use the cost price, but we are going to use what? The carrying value, in which is also known as what? Book value. And then guys, how are you going to be able to get your carrying value or your book value? Then we are going to say cost price minus accumulated depreciation. Then it's equals to our carrying value or book value. So now guys, let's start with our old equipment. Our old equipment, it's how much? 40,000, and then its accumulative depreciation, it's how much? 7,600. And then we have our cost. This is our cost. And then we have our what? Our cost price. This is our cost. And then subtract our what? Our accumulated depreciation of how much? 7,600. And then this one is our what? Accumulative depreciation. And then it's equals to our what? Our carrying value. And then guys, we are going to say 40,000 subtract 7,600, and then our carrying value is 32,400. And then guys, now we can be able to what? To apply our percentage. And then we can say therefore 32,000 as our carrying value multiplied by what? By the percentage that has been what? Provided. And then how long will the equipment or an asset be available in the business? Will be available throughout the what? The year, since we are not selling it. And then it's going to be multiplied by 12 over 12. And then our depreciation is going to be what? 32,400 multiplied by 10 divided by 100 multiplied by 12 divided by 12, the months. And then guys, we have 3,240 as our depreciation for the old equipment. And then guys, now we can calculate our new depreciation for the new equipment in the business. This one does not have the accumulative depreciation because of it's still new. Then we can what? We can just apply our percentage and say multiply by 10 over 100 multiply by the what? By the months in which the equipment will be available in the business. Meaning guys, as I always told you, make sure that you master your date. And then it was bought when? It was bought the 1st of November. Then 1st November we bought, then meaning it's available this month of November. But if ever this equipment was bought when? On the 30th or the 31st of November, then we'll start counting from when? From December. So right now we are going to start counting from November. Then it will be available in the business for many months? 1, 2, 3, 4. And then it's what? Multiply by 4 months divided by 12 months. And then our depreciation for a new will be 96,000 1000 multiply by 10 divided by 100 multiply by 4 divided by 12, and then it will depreciate with how much? 3200. And then guys, in depreciation for entire year will be what? 3240, which is our old, plus our 3200, which is our new. And then at the end, our final depreciation amount will be 3240 plus 3200. Then we have how much? 6440 as our depreciation. So guys, in this thing, it's a bang, guys. Go home, go to your income statement adjustment, try to look for similar transactions based on depreciation, guys. And if ever you don't understand, rewind the video, guys, while you subscribe, rewind the video while you like, rewind the video while you press that notification button, so that whenever I upload, you are notified. So guys, in this thing, it's a bang.